Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Dan Dolev, senior fintech analyst at Mizuho Americas, to discuss global payments and the growth gap between traditional and next-gen issuers. Dan, it's great to meet you again. Welcome back to Trade Talks.
Thank you. Always a pleasure being here.
And Dan, are traditional issuer processors increasingly losing their competitive edge?
Absolutely. I think that there's a huge new next-gen issuers which are processing the cards of like the Ubers of the world and the DoorDashes of the world. And the traditional guys are not getting this business. And that's why over the long term, they're losing their edge.
And what's contributing to the growth gap?
I think what's happening right now is that, modern APIs, which give you more agility and more flexibility, those new issuers like the SoFis of the world or Carta, which is owned by Mogo, they're developing them and they have them, and that compares with some older traditional guys like the GPN, which owns TSYS, and they just don't have them. And this sort of competitive advantage is what's going to increase the bifurcation in growth between the traditional issuers and the next gen issuers.
So then you think the growth advantage for next-gen processors may continue even further. And what are some of the companies that fall into next-gen?
Yeah, this is a great question. So there's a huge, long tail of like startups, but like the two big ones that we wrote research about was Galileo, which is owned by SoFi, and also Carta, which is a relatively small company, but it's owned by Mogo, Canadian fintech company. So those are the ones that we focused on, and where we saw like real evolution of next gen APIs and modern technology that gives them that competitive advantage over the traditional guys like GPN TSYS.
I also think part of the issue is legacy systems have the challenge of age and siloed functionality. What are the modern systems embracing that give them the competitive advantage?
Yeah, it's a great question. So if you think about the typical sort of new transaction, like a DoorDasher, right, it goes from from a restaurant to a consumer. So there needs to be a card that's issued in real time, like a virtual card that has to be issued in real time. It has to be very flexible, very agile, and it all has to be done in real time. And I think those traditional guys where the systems have been developed like in the 70s or 80s at times, they just can't do this, right? They're not built for this kind of agility. And that's the competitive advantage. It's the modern economy, the gig economy that really nurtures the growth of these next gen issuers. And that's what they're designed to do. And that's why they're going to see 30+% CAGR over the next few years, because that's what their underlying markets are growing at versus like it's decelerating CAGR for the traditional guys.
So Dan, let me ask you one more question just so I understand it correctly. What are the legacy processors going to do? Can they catch up at this point, or will the integration be too slow to catch up to the next gen issuers that don't have to worry about this old infrastructure?
Yeah, I think at this point in the game, it's a little bit too late, and they're just basically the technology is just not there, and they're tied to the banks, right? And the banks are consolidating. The traditional banks are slowing as well, so their volumes are not going to grow, or they're going to grow slower over time, and basically that's going to have a ripple effect that's going to slow down the volumes of the issuer processors who are issuing cards for those, or who are processing cards for those banks. So I think at this point of the game in 2021. It's kind of like it's going to be very hard for them to kind of reinvent themselves, and you're seeing the growth, for example, of TSYS, which is owned by Global Payments, going from 10% like 5 years ago to mid-single digits to like negative growth or flat to negative growth now, and it's a massive deceleration over the years. So it's not going to look any better than that. And they're guiding to low single digits in 2021, which is the kind of the biggest recovery year ever. So it tells you something about the nature of that business.
All right, Dan, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.